anything that happens within a 24-hour period is noise. And I think that once the market understands that we are focusing on fiscal consolidation and that we are trying to bring the market back into equilibrium in a thinly traded market.
Treasury Secretary Scott Bessent telling us to tune out the noise around daily market swings. But investors aren't listening as bond markets question America's fiscal path. And Walmart's earnings raise fresh doubts about the resilience of the U.S. consumer. So a bigger question is emerging. What signal and what is noise? Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Oil heads for a sharp weekly gain as Washington moves to isolate Iran's economy. Brent nearing $94 as traders brace for fresh supply disruption. Alibaba shares swing after faster cloud growth and stronger margins ease AI spending concerns. Investors weighing those metrics against profit pressure and rising capital investment. And Indian regulators ban a JPMorgan-linked entity and a brokerage after alleged auction manipulation, underscoring efforts to protect India's new market closing system. Our top story today, Asian bonds and the dollar remain under pressure after a rally in Treasuries faded. Bonds falling in Japan, Australia and New Zealand, tracking their U.S. peers and giving up much of the gains from yesterday. The reversal came even as Treasury Secretary Scott Bessent flagged he's prepared to expand debt repurchases and unveil a new fiscal plan. For more, let's bring in Bloomberg MLive strategist Mark Cranfield and our very own markets reporter Anthony Stevens. Mark, let's start with you. It does seem like Treasuries can't catch a breath, and perhaps Bessent is learning it is hard to contain those long-end yields.
It's a very huge market, the Treasury market. The public debt in America is $40 trillion US dollars. Traders can see that the kind of money that Scott Bessent is thinking about doing buybacks with is really just a very small fraction of this enormous market. And it would need to be very skillfully done in order to persuade people that they should go fully along with his thinking that yields have been capped, when at the same time, the US government hasn't put forward a coherent plan for how they're going to get the fiscal deficit down to the kind of levels it was 6 or 7 years ago, let alone where it was when it was close to being balanced. So until they address that, traders can see there's some holes in this strategy. And you have in the background as well, you have the situation in the Middle East, which is keeping oil prices very high. That feeds into the inflation situation. There's no particular sign that is going to be addressed. And apparently, Mr. Bessent on Monday is going to announce new economic measures against Iran, which may well make the situation with oil prices and energy contracts even worse than it is now. So that's not going to help the long end of the bond market either. So in a way, traders are just telling him, look, it's an interesting plan. There's a few holes on it. Come back and tell us when you're serious.
And Anthony, the question remains, how might this impact the stock market? So far, not really, right? Because CapEx earnings all looking pretty hunky-dory.
Yeah, and that earnings story is supporting a corporate bond market that is in extremely rude health, right? All the corporate bond market needs is for the long end to be minimally anchored. And that's why there was that mini freak out in stocks when the Treasury long end looked unanchored. So as long as the Fed or Bessent is doing something about yields, anything about yields, that's enough for the stock market. And you did see, for example, Broadcom come to the market in a really big way. Closer to home in Asia, IG spreads spreads are at historic lows, and that's supporting the bull market in the stocks, right? Like raising incremental capital for AI capex is extremely easy in the bond market. All you need is yields that are a little bit anchored for stock market performance to continue. So you're seeing very strong performance again under the hood overnight in the US, with the AI semiconductor plays outperforming the broader market, especially the consumer names. And we have more of the same in Asia today, with the Chinex, for example, outperforming the HSI, Korea doing quite well. And you're seeing some of that cash come back to investors in the form of shareholder return programs, most notably from the Koreans in Samsung and Hynix.
So, Mark, whether yields are anchored or not, that is the big question. But the thing is, even as we talk about surging yields, they're not that high, are they? If I take you back to 1990s, we had yields at 6.5%.
It's more about the velocity of the moves rather than the absolute levels. You're quite right. Interest rates around the world have been much higher than they are currently, not just in the US, but in Europe and even in Japan as well. I can remember 7% yields in JGBs. But the point really is about how quickly the increases in the yields go. And that's probably what was unnerving the US administration recently, is that yields were going up fairly quickly. The curve was steepening, and that was making everybody a bit jittery. So we've seen a similar situation in Japan. From time to time, they get edgy when yields are going up too quickly or the yen was falling too fast. But what investors are now looking at is the fallout from these things. As Anthony's correctly saying, overall, when you have the US Treasury intervening in this way, it's going to give risk appetite a boost. But that's probably more to the equity market than the bond market. There's going to be a fallout somewhere. And it looks like the weak link in all of this is the US dollar. It looks like America is throwing the dollar under the bus, because when global investors lose confidence in the policies of any particular country, the currency is like the share price of that country. So if people are not so keen on what they see, they will buy or sell your currency accordingly. And now the US dollar is probably going to be on a long-term downtrend, as people think that monetary policy and fiscal policy are not aligned. There's too much intervention in free markets, and all of that is detrimental to people that want to put their money in the US dollar. So people will be looking for other outlets. Asia at the moment is seeing a great sign of money coming back. Look at the Korean won, Taiwan dollar, Chinese yuan, all very strong. And so there's going to be the fallout. The US dollar is likely to trend lower for some time.
And Anthony, what might eventually break the equity markets? I mean, we talk about surging or elevated oil prices. That could be a factor as well.
It really depends on what stock market you're talking about, right? So the oil and the inflation story is already cracking the consumption leg of major stock markets, whether you're talking about European luxury or US mass retail or any of these China internet e-commerce names. That's already cracking. The AI side of the story is going to be cracked by AI innovation, and that's why you've seen the biggest markdowns on that trade when Chinese competition comes in at low prices, or there's a big innovative shift in how the Chinese use AI compute. That's where the disruption to that trade is coming from. And that disruption has not passed. It's very interesting to note that momentum is still down, compared to the July kind of ruckus, right? So people have not recovered from that. And underneath the hood in the AI trade, there is a lot of dispersion happening as the technology moves very sharply forward. You're seeing data centers do well and LLMs lag.
Bloomberg M Live strategist Mark Cranfield and our markets reporter Anthony Stevens, thank you so much for those insights. Let's get more perspective. Kaia Parv, market strategist at First Degree Global Asset Management. Kaia, good to have you with us. We heard from Scott Basson. He says yields do not reflect fundamentals. They don't?
Thank you so much for having me, and happy Friday. Scott Bessent, I think we have figured out that there is such thing as Bessent put, and this is roughly about 530 for 30-year. Now, many of the previous speakers have highlighted the fact that this is just a drop in the ocean. It's an attempt. It almost comes across as a little bit desperate move in the height of global sovereigns having a little bit of stress. I think we shouldn't look US just in isolation, because a lot of the traders and market participants look sovereigns as a group. So this is not just in the US, we see the same in Japan, we see the same in the UK. China, of course, is a bit of an exception. And I would say that you can't really control the long end because this is dominated by the market participants, and until the little technical term called term premium doesn't come down, I don't think anything Treasury can do, because currently we're putting a band-aid on a bigger problem.
But I'm just wondering whether fundamentals are actually intact. The fundamentals are getting a little bit cloudy right now. You take a look how Walmart sales came in at the weakest in about a year, and consumer sentiment isn't so great after all.
Yeah, but it depends what fundamentals we are talking about. I mean, you talk about consumers. The
fundamentals of the economy.
Definitely.
And the consumers drive the economy.
Definitely. But right now we are seeing it's the capex that is pushing the economy forward, or pulling the economy forward. Without the AI capex spending, I don't think we would have any economic growth in the US and globally for that matter. I think we'll be rather stale and potentially seeing some sort of little bit of sentiment happening on the other tech sectors. I would be very mindful about discounting US consumer completely. I think the top 10% is still pushing the economy ahead. But again, we've heard a lot about the K-shaped economy. And I believe these earnings results that you are quoting are reflective of the lower, maybe decile of the consumer segment.
Interesting as well that Besson pointed out that if hyperscalers want to issue bonds, they should be focusing on the belly rather than the long end. I mean, one, it is interesting that he's weighing on the issue, and two, is he right?
He is right from the perspective that looking at the yield curve steepening, we have seen a lot of steepening happening at the long end of the curve. The belly has been rather tamed. But again, for me, the question is, who is the marginal buyer? I see currently the buyers are on strike. Unless they get better yield, they get better rates, they are not going to participate in the credit markets. And I do believe that credit markets are probably the first signal for us to see the stress. Double B's, triple C yield is actually acting up, although the credit as a whole is a very well behaved for the time being, but the spread between double B's and triple B's, I wouldn't say are signaling a distress, but they are definitely at least giving me a bit of something to focus on. Where is this trend going? Are we going to see further widening? And if that happens, is that going to trickle down into the IG as well?
There are expectations that the market will punish Besant and U.S. assets for it. Where do you see 10-year yields headed? When might it get to 5?
Great question. I actually think it might even reach 5% by the end of the year. The catalyst for me actually is the US midterms. Are we going to see a divided Congress? If yes, that could put a little bit of a lead on US spending. But I think it's just a short-term fix potentially. It's still the term premium that's arising from unknown what's happening in the Middle East, what's going to happen in inflation. Are we going to have further communication coming out of the Fed? All of this add to the term premium, and in my view, they will push the yields up at year end.
Kaia, hang tight. Kaia Parv, first degree global asset management, is sticking around. Up next on Inside, Alibaba's quarterly profit falls 75% as it ramps up capital spending for the AI race. We'll have the numbers, we'll have the outlook as well. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. We're watching shares of Alibaba after the Chinese tech giant reported a 75% decline in first quarter profit. That's as it increased capital spending to almost $10 billion, aiming to safeguard its position in a fiercely competitive global AI arena. Let's dig into those numbers with our China correspondent, Min Lo. Min.
Oh, hi, Haz. Yes, we did see, if you look at the stock performance, it's taking a bit of a dive now, and it looks like investors are still not too satisfied with the earnings, right? Revenue came in line with estimates, 9% growth, but then its net income, as you said, 3/4 of a decline compared to the previous year, and this is because of its huge AI investment, right? They spent close to $10 billion last quarter, and remember, you just multiply that by 4, it's an annualized rate of $40 billion, which is trending much higher than their previous pledge of about $50 billion in 3 years. So investors are asking, is it worth spending all that money? You take a look at that last metric there, free cash outflow doubling from the previous year. So a huge amount of spending. A part of it is because of high memory costs, because the company did mention that the cost of setting up a new AI server is doubling as a result of that. So you take a look at the revenue breakdown here. E-commerce is seeing some softness, particularly when it comes to quick commerce. It is expanding, but the losses are narrowing rapidly, but it's only expected to turn profitable in fiscal 2019. Cloud computing, 48 billion yuan. That is the biggest bright spot now. It grew by 45%, which is the fastest growth in 22 quarters. So a lot of optimism around its cloud business. The margins are improving as well to 11%, which is some of the best in the industry right now. But if you just eyeball all of that numbers there, you can see that e-commerce still makes up 75% of their business. So even that improvement in cloud perhaps is not enough to offset the softness in the e-commerce front.
Might we see better numbers in the quarters ahead, Min?
Yeah, so this was something that the CEO spent some time reassuring investors on. He said that he expects the AI spend to be self-sustaining within the next 3 years, meaning he says that they will recoup all that investments in 3 years' time. And he expects AI-related revenue this quarter to come up to close to $10 billion. And they're expecting to ramp up, or at least targeting to ramp up AI-related revenue by 5 times in 5 years' time to hit $100 billion. So very strong ambitions there to build up that full stack of that AI services, from the chips to the AI models to the applications on top of it. But again, you look at the AI model, right? Even though it is the most downloaded ones globally right now, but then it's still extending losses, which shows you that the inference cost, the training costs to power these models are extremely high. And at this point, even with high usage rate, it is not bringing profits to the company just yet. So we'll have to see whether those investments really pay out and whether they can meet the target to break even in 3 years' time.
Min, thank you so much for that. Bloomberg's China correspondent, Min Lo for us in Hong Kong. Kaia Parv, market strategist at First Degree Global Asset Management, is still with us. Kaia, your thoughts on, well, it's not surprising, right? Everybody's looking at ROI and Alibaba disappointed.
I do appreciate the CEO's comments that he thinks the future quarters will be better in terms of revenue, but let's not forget you also have a look at the costs. And a large chunk of the CapEx increase was due to memory getting more expensive. It's fascinating for me to see how the memory layer is currently about 40, 50, 60% profit margin, but the implementation layer, the hyperscalers and the consumer are actually not participating in that profit. I mean, OpenAI, severe loss. Alibaba, their cloud division makes marginal profit, but the costs keep going up. So who's going to pay for all that? And I think still that the business model for Alibaba, for many of the application layer players, hasn't been figured out.
So what do? Do you wait till the numbers improve before, pumping money into these stocks?
As a global allocator, you really can't wait. You have a mandate, you have to allocate. I think we're going to see a bit of shifting in terms of allocation because we have a lot of issuance coming to the market. We have Anthropic coming with the IPO. We have a lot of credit issuance coming too. So we can see a bit of reallocation, I think, within the markets. Probably those a bit more stressed assets, maybe Bitcoin is another example, could be under more stress because investors do want to still join the AI race. They still want to participate. They want to get some sort of profit and some gains.
We talked about the bright spot for Alibaba being cloud, right? I mean, profit revenue up 45%. I'm just wondering whether that's enough to allay concerns and whether that's enough to have you think that perhaps the Chinese AI players are doing it better than hyperscalers in the US.
CapEx is very high, negative cash flow. For me, this is what I would focus on. But arguably, Chinese are doing it cheaper, better in a way, depends what metrics you use. And this is a model that China has implemented extremely well. We've seen it across other industries as well, be it solar, be it electric cars. The US does it first. They spend a lot of capital. They go through that R&D cycle. And then China comes in, replicates to some extent, but also innovates a lot. So I do see Chinese models probably being more implemented globally. And most likely China will catch up with US in the AI game.
In the broader Chinese market, where else do you see potential for, pumping money into the different sectors in the country?
I think in China, generally, the tech sector is doing pretty well. But as an asset allocator, I'm mindful about China as a whole because there is significant regulatory risk or political risk, if you want to call it. And we have seen quite a few industries being reshaped, the government stepping in, wanting to regulate more, wanting to govern more. And I understand, but as an asset allocator, I think China at this point is not a priority in terms of asset allocation.
Not even its bond market, which is on the extreme of what's happening with the rest of the world, especially the US. We're seeing, yields actually falling in the Chinese market.
As a bond allocator, credit allocator, I do appreciate yield. So Chinese 1.86%, I believe, is not sufficient for allocation. I think it's good for those local investors that have to allocate again, and we see a lot of this in China. But I think in terms of yield pickup, it's still global, it's still hyperscalers, it's AI-linked credit, albeit the business models haven't fully been proven yet.
And what's the biggest risk right now?
For me, it's the credit markets. I think we're going to see the first cracks emerging in the credit. For me, the US tantrum, I would say, is a bit of an indicator, Japanese tantrum, a bit of an indicator. If this trickles down into corporate markets, especially in investment grades, I think that's the first sign of potential distress, and equities generally are a bit of a laggard. And at that point, maybe it's worthwhile allocating a bit more into cash.
What might trigger that crack? And what would that eventually lead to?
That's a great question. I don't know. I think these things happen slowly and then they happen at once. So it could be anything. It could be negative earnings results coming from any of the hyperscalers. It could be additional capex that the market hasn't expected. It could be even oil price, like you rightfully pointed out earlier in the previous segment. So one of these things might be just the last straw that breaks the camel neck.
What are your views on what are deemed as the alternatives to the US dollar? We've seen the rise in gold. We've seen the rise in Bitcoin. People are now looking at alternatives to the US dollar and, pumping more money into these assets. Is that the way to go forward?
Well, I think dollar is still dollar. When serious stress emerges, I think investors will go back to their old playbook, which is US Treasuries, which is the dollar. This might emerge when we see the true stress. But I think gold definitely will be and is already a beneficiary of the US dollar weakening.
All right, Kaia, thank you so much for that. Kaia Parv, market strategist of First Degree Global Asset Management. And we have breaking news right here from Reuters saying that Pakistan's Imran Khan has been taken back to the prison from the hospital. Pakistan's former Prime Minister Imran Khan, of course, here we're talking about, has been moved back to prison from a hospital in Islamabad. And that's according to Reuters news agency, citing a spokesman for his party. And still to come, we get the outlook for India's earnings season and the turmoil surrounding the country's new closing auction system. Lakshmi Iyer of Bajaj Finserv will be joining us with more. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. India's market regulator has banned JPMorgan's Mauritius unit and Indian broker Mansi for alleged manipulative trading last week. The crackdown underscores SEBI's determination to ensure the success of the closing auction system. India equities reporter Savio Shetty joins us from Mumbai. And Savio, tell us more about this pretty speedy rebuke of JPMorgan unit Kopthal and local broker Mansi. I mean, this happened faster than anything else before.
Absolutely. Good morning, Haslinda. Nice talking to you. So it's very clear that this is probably one of the fastest turnarounds we've had from SEBI. I think there are a couple of reasons for that. The main headline reason is clear. The closing auction system is here to stay. And if there is any limited or anything that SEBI sees in terms of manipulation, it is going to come in, and it's going to come in fast. The second, I think, slight technical aspect here is that both the entities had open positions for yesterday's expiry. So there was a certain fear that the manipulation would probably happen again, which is why I think SEBI just stepped in one day before, which was on Wednesday, and went to it. The broader picture is clear that India's closing auction system is facing some teething issues, but it seems that the regulator is also fairly clear that they've spent time on this. The discussion paper was in public domain for well over a year, and they are going to go through with this.
As you said, the closing auction system has been pretty problematic. How is it doing now? It depends on who you ask, to be very honest. A lot of strategies have pretty much gone out of the window. We wrote extensively on some strategies and options pretty much being buried alive. I think there are some issues, especially when it comes to what the indicative price actually shows you and where it ends. I think most players are still in a wait and watch mode. We had reported that much of the HFT crowd, or the high frequency traders, are actually voting to stay out of this because they first want to see liquidity. So I think it's a kind of a chicken and egg problem. But I think as we go forward, we should see some kind of clarity emerging. A couple of experts that we spoke to say that this could take anywhere between 3 weeks to a month for it to kind of become normal. But what are the possible challenges that the system may undergo in the coming months?
Absolutely. So I think there are two big challenges on the horizon. Challenge number one is Tuesday, 25th of August, which is the monthly expiry. Remember, up until now, all the expiries have been on Nifty, which is a weekly expiry. When you have it on stocks, there is a completely different game at play there, because you will have arbitrage funds who will come and try to unwind their arbitrage positions. That's test number one. Test number two, and a much larger test, is August 31st. August 31st is where MSCI there's the MSCI rebalancing that happens. We'll have like billions of dollars of flow in and around that system, and it's and we have to look as to what exactly do passive funds do. Currently, the volume is somewhere between 1,500 crore rupees, but the flows that are expected to come in or go out in that matter in terms of a churn are much higher. So we'll have to wait and watch. So I think these are the two big tests that cash goes through. If it actually does go through with these two tests relatively unscathed, I think we are okay. But I think these are the two main ones.
Savio, thanks so much for that. Bloomberg's India equities options reporter Savio Shetty there for us. Let's get more with Lakshmi Iyer, Group President of Investments at Bajaj Finserv. It's India's most diversified non-banking finance company and the financial arm of Bajaj Group. Thank you so much for joining us. Lakshmi, I mean, we've been talking about the auction system. Any thoughts on that?
Hi, good morning, Haslinda. I think Savio has covered it pretty much in detail. It's very early days, and any system, when it's introduced for the first time, typically tends to have teething trouble. And it's not that India is the only isolated case there. We've seen that when systems like these were implemented across the world, obviously, initially, there were these kind of issues. So I think it's a matter of time that we should see these getting resolved.
Do you think India is actually getting into an era of higher regulation?
Not really. If you're referring to this particular, CAS, which is closing auction system, I'd say that, whether it's NYSE or LSE or Hong Kong Stock Exchange, I think each of these have the modus operandi is very different. It's a matter of time that, as we are, expanding, the base market cap is on the rise. I think it's a matter of time that these best practices, which the globe is obviously doing, definitely step into India as well. So I don't see that as excessive regulation.
Lakshmi, I want to take you to the Indian equity market. It remains to be lackluster. In fact, foreign investors have been pulling money out. The amount this year so far exceeds all of last year already. What is the catalyst that's going to change this?
So, a couple of things. If you see that there obviously has been a lot of, I would say, valuation-related concerns compared to, say, the emerging markets or the rest of the globe. The good part, Haslinda, is that quite a bit of that is starting to abate. Are we saying that, lo and behold, this entire FPI or the foreign investor movement, which was negative, is going to hugely turn positive? Well, not really. But if you see the last 2 months, specifically the months of July and the month that we are in, I think the trend is clearly giving you a positive signal. This month alone, we're touching close to about $2 billion of net flows. Last month was close to about $3 billion. Also, if you see the valuation gap because of this underperformance of India, the valuation gap is clearly crunching. Of course, it's now closer to the long-term 10-year averages. The Q1 earnings have been absolutely fantastic. And it's not just cyclicals which have done well. It's across segments and sectors that we've seen very positive, I would say, high teens or mid-teens kind of growth. And in fact, if you see on a year-on-year basis, this is the best quarter that we've seen in the last 10 quarters, 9 to 10 quarters. So I'd say that things are evolving, things are getting better. We're not yet there, but I think, 17-year low of FPI participation also gives a massive ownership opportunity for the foreign investors.
You talk about the valuation gap closing, but India remains the most expensive among major economies. And you also talk about earnings, providing the support. Do you see earnings eventually helping to reverse course for the Indian equity market?
It definitely looks like that, Haslinda. If you look at the upgrades versus downgrades, for every 15 upgrades that you see, there are just about 10 downgrades. So clearly the ratio is tilting in favor of incremental earnings upgrades. That's point number one. Point number two is look at, except for oil marketing companies, obviously, because crude continues to be a big joker in the pack for a country like India, across segments. And it's not just metals, which I mentioned, which is more cyclical. If you look at the auto sector, look at the passenger vehicle demand, look at the commercial vehicle demand, look at the financial services where there has been asset quality, which has been intact. There has been credit growth. There has been a top line growth. So I think it is clearly visible that there is an en masse general uptick in the earnings momentum, and that could likely flow in through probably the next year, which is FY 2028. I think the key for investors to note will be, especially the foreign investors, are they going to be sustained upgrades? Till such time we don't see that, I think some bit of this is going to be more sentimental. And I must also bring in, the activity in the primary market. I think that also has started seeing some renewed momentum. I think all of that kind of acts as a strong catalyst for foreigners to take note of India.
I want to take a look at the RBI. The latest minutes at least have been pretty hawkish. And when you take a look at the markets, it's been pretty split, on when the RBI might hike. Some say at the end of 2026, others say perhaps earlier than that. What's your own take on when the RBI might make its move?
did, obviously, it was a status quo. What RBI suggested in the minutes, I think there is concern around inflation, and that inflation is emanating obviously largely from commodity prices. So it's going to be a definitely tricky situation. Our base case assumption is that we don't really see any rate action, at least this calendar year. But look at crude oil prices. As we speak, crude is already on the rise. So I think there are so many moving parts. And of course, we need to take cues from what US is going to do as far as their rate action is concerned. So I'd say base case, no rate action, but it's so evolving. The markets are definitely pricing in a rate hike end of this financial year, that is by March 2027. And obviously the bond markets are also taking in cues from that. But for now, I think markets are not overtly disturbed about the rate action for sure.
I'm just wondering how you're assessing the surging yields in the U.S. We've seen the play-through in the Asian markets. I mean, how, the yields in Asia have been moving in tandem with the U.S. How might this impact India's own market?
In India, if you see, there is reasonably strong appetite for government bonds, largely from Indian banks and Indian pension funds and terminal benefit funds. It's not really hinging on foreign participation, which is what the case has been for a very long time. So I think that definitely will continue for the foreseeable future is what our view is. Unless we see a fiscal slippage, which is again not our base case assumption, because that leads to more supply of government bonds. So I think we are likely to see a tight range of bond yields. Maybe we could edge towards the 7% mark if US yields were to continue its upward march. So I think we're looking at a tight groove of maybe lower end of 6.75, 6.8 to upper end of 7%. But it's clearly going to be a very tight groove because we have clear demand levers in the domestic market, which is supporting the momentum.
Before we let you go, Lakshmi, just a question on the rupee. What could be the next pressure point for the Indian rupee?
Well, so far, I think we've showed up our foreign exchange reserves by close to about $40 billion. That's given a reasonable, stable bias to the rupee. But I bring in crude oil over here. We are edging upward. Unfortunately, we can't do anything about it as a nation. And I think that clearly means that dollar rupee at this point in time, can be on a slightly sticky wicket. But I must also mention that the dollar is weakening. And given that, we've seen $40 trillion in terms of the debt. So I think given that sort of a scenario, I'd say that we are probably looking at a slightly more stable currency, given that the forex is more comfortable, but we can't be complacent.
Lakshmi Iyer, Group President Investments at Bajaj Finserv, we thank you so much for your time today. Still ahead on Insight, the world's fourth largest aircraft leasing firm, BOC Aviation, posts record first-half profit. CEO Steven Townend joins us exclusively with the outlook as the Iran war stalemate keeps fuel prices high. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Shares of BOC Aviation fell in Hong Kong even after a record first-half profit, with net income rising 4% as all of its major businesses lines improved. The world's fourth largest aircraft leasing firm generated $1.3 billion in revenue and other income while raising its interim dividend by 22%. Joining us exclusively, BOC Aviation CEO Steven Townend. Steven, good to have you with us. Are you surprised that the markets took your numbers pretty negatively? Stocks are down.
I think our first half result was a strong one. We delivered $357 million of profits. As you said, we moved forward. All of our business areas improved year on year. We've still got a strong balance sheet. We grew that probably slightly ahead of expectation, and we declared a higher dividend. So somewhat surprised.
Any clarity for the coming quarters? I mean, how strong is the demand for aircraft?
There's still a structural imbalance of supply and demand for aircraft. This year will be the first year since 2018 that actually will get back to delivering that same number of aircraft. So you've had so few aircraft delivered during the intervening years compared to expectation that the shortfall is into the thousands of aircraft, not the hundreds. And that's going to sustain for a long period of time. If we look at what's happening in the supply chain, that constrains the ability of all the manufacturers to ramp up, and therefore this is going to remain probably through till the end of the decade.
So can you quantify that demand? I mean, we have seen an improvement in terms of delivery, right? But what kind of pace are we looking at, and what kind of demand are we looking at?
If we look forward through to the end of the decade and we apply even conservative growth in aviation, at the same time what's also happened is that people haven't been able to retire older aircraft because the newer ones haven't been coming in. So in the last 4 years the average global age of the fleet has gone up by 2 years, and so we're going to have to start to see a higher retirement wave as well as meeting that growth and meeting that traditional demand. And supply just can't keep up. So that will mean that maybe by the end of the decade on the narrow body side it comes back into balance, because that's where both Airbus and Boeing have been focusing their efforts to try and rebuild the supply chain, get that stability back. On the wide body aircraft, we are nowhere near getting back to those 2018 levels of deliveries, and they aren't ramping up as quickly, and so that imbalance could run for much longer on the wide-body aircraft.
To be sure, though, airlines are not having a great time, and we're hearing stories about airlines pulling back on their growth plans. Is that what you're hearing?
It's different in different parts of the world, I think. Clearly the biggest direct impact to all airlines has been the change in the jet fuel price. And jet fuel has gone from approximately $90 a barrel at the beginning of the year to roughly $150 a barrel today. And that's one of their largest costs, and so that does have a direct effect. But the key question is, can they pass that through to the consumer? And that's different in different parts of the world. Very much in North America, what they're seeing is that they can pass that through, and that they can push through higher prices, and demand is not really falling away. Europe's been different because the airlines were much better hedged, and so it's had less of an effect, and they have been able to cover a lot of that increase. Parts of Asia have definitely struggled. China's different again. China, because of the breadth of their high-speed rail network, if they try and push through those large fuel increases to the airline passenger, people will travel further on high-speed rail, and so it's been more challenging for them to pass that through.
You talked about how parts of Asia are struggling. Are these airlines having difficulties in financing, and are they approaching lessors like yourself for more financing as a result of that?
For all airlines right now, if they're looking forwards, they're going to want to conserve cash. That's the logical outcome of where we are. None of us know how long these fuel prices will stay where they are. And so if you're in a market where you can't pass all of that through by way of fare increases, if you're in a country where perhaps your domestic capital markets are not so deep so you can raise funding from that source, then an obvious way to do that is to look at your aircraft. And so either perhaps your new deliveries, if you are planning on financing half of them this year and paying cash for the rest, now maybe you think about financing all of them. If you look at your existing fleet, maybe you've got some unencumbered aircraft, you sell those and lease those back. Perhaps if you've got a large order book with Boeing and Airbus and you're due to make greater pre-delivery payments this year as those ramp up in the future, then you're looking to people like us to fund that as well, so you're not getting additional cash going out the door.
But I'm just wondering, in terms of airlines tapping lessors like yourself, I mean, in terms of percentage, 30-40% perhaps of your customers are tapping you for financing help. Is there a way to quantify it?
I mean, if we step back and look at the global aircraft fleet, about 50% of all aircraft are owned by leasing companies such as us. And that comes in two ways, because it's either people who are taking aircraft from us, from our order book, to build their capacity, or it's people using that capital. And certainly we're seeing an uptick in people wanting to access our capital. We saw that in the first half of this year. That's why we completed $2.3 billion of CapEx, which was ahead of our guidance for this year. But at the same time, we still have airlines coming to us looking for new technology aircraft. Because again, if you think through, they're trying to position for a world of higher fuel prices, you want to have the most fuel efficient aircraft, and therefore you want to speed up that transition. And so at the same time, we're still having all of those discussions, and people are looking through this. So even this week, we are talking to airlines about placing aircraft on lease that won't deliver until 2029 or 2030.
Who's hurting the most right now?
Who's hurting the most? If you're an airline perhaps that was weak anyway going into this, if you're in a market where it's difficult to pass through those fare increases, if you're perhaps in a country where domestic capital markets are not so deep, and in particular then if you had quite a number of routes in and out of the Middle East, then that will all add up and create issues for some people.
That sounds like most of the Asian airlines.
It's not all. It's not all. I don't want to comment on any individual airlines, but there will be challenges for airlines in Southeast Asia. But there are bright spots as well. If you were flying from Asia to Europe and you were competing with all the airlines where they were stopping off in the Middle East, a lot of that traffic now is going direct, and you can actually charge higher fares for that if you're in that position.
How are you looking at your own business? You have a pretty deep pocket right now. I mean, some would suggest that M&As could be the way to go. Are you looking at M&As?
We're actually...
Don't be shy, Steven.
We're actually unique in terms of the big players in our industry. We're the only one of the top 5 in our industry that's never undertaken any M&A. We've always grown organically, whilst the rest have all grown through some form of M&A. And that remains our base case, that we can see how we can grow the way we want to, how we can stay as one of those top 5 globally through organic growth. But if this volatility creates opportunity, of course we will look at it.
Are you seeing possibilities right now? I mean, given the uncertainties and given your strong position, are you in negotiations, perhaps?
We haven't reached that point yet. I think this will have to run for, this sort of volatility will have to run for longer to create those types of opportunities.
But on the lookout for it?
We'll watch it. We have the lowest marginal cost of funding in our industry, and so where we can see opportunity to grow, we will take that.
All right, Steven, thank you so much for that. Steven Townend, MD and CEO of BOC Aviation. And of course, subscribers can watch us live and see our past interviews on our interactive TV function, and that's TV Go. You can also dive into any of the securities or Bloomberg functions we talk about and become part of the conversation by sending us instant messages. Do check it out. It is TV Go. And that is it for Insight. Horizons Middle East and Africa is up next. Keep it here with us. This is Bloomberg.